What did we learn from 2008? Well, if you want to get all philosophical, you would say perhaps that people were reckless, but then people work in herds. They follow other people, and a few contrarians, let's say, managed to stay out of the mess. And when the crash came, and if they had cash, then they bought loads of good deals and made a lot of money. But in a more kind of low level way, what I've learned from analyzing all this data is that there are certain distinct patterns. Now, what I'm going to do, by the way, is in the resources section, you're going to see some screen grabs, and they're just big, uh, big JPEGs, and each one shows the data for the UK for each of these three things, and you can look at the different pictures and you can kind of compare the patterns and just see what's going on. And then from there, if you look at the trends, then you can get some insights and you can make some decisions about which areas you think are good for growth based on your appetite as an investor. But broadly speaking, the patterns that I've seen based on this data and also some correlation analysis I've done is that the higher the social demographic, the more robust the area is in a downturn. Now, that sounds really obvious, but one thing is an anecdote going, well, that's that, but another is just looking at some very strong correlations to prove it. And to me, there's solid evidence to say that areas which are better off do better in a downturn, but on the way up, as in a market upcycle, they tend not to do so well. So really what I do with my clients is look for those areas which are as robust as can be, that are cheap enough to make buy-to-let purchasing work, and which have the greatest promise of future capital growth. A good example of an area that I like, for example, is Swinton, which did okay-ish on the way down and suffered like 27% capital decline. But on the way up, it's been very robust. So 50-60% real capital growth. And what's interesting about this area, for me anyway, is that the median house prices are low enough so that they work from a yield point of view. So in other words, you can get a high enough gross yield on a property in order to make the deal work. And if we look at the short-term story, we can see that Swinton has been very strong indeed. And this is just a typical decent demographic with good proximity to central Manchester. And it benefits, I guess, from Manchester being a strong city overall these days. And so that's an example of an area which is a nice balance between robust on the downturn, strong on the upturn, and probably fairly safe for a future crash. So the main lessons, I suppose, from 2008 are accepting that areas don't change that much and the characteristics don't change terribly. There are shifts, citywide shifts. So overall, for example, Manchester has done so, but this cycle, I think it's much stronger. If you look at, say, Liverpool, for example, in the 2008 crash, you can see that overall it did relatively badly. There were very few places which were at all robust. Like just almost citywide, the place got decimated in terms of property values. Whereas in Manchester, there were patches which were reasonably strong. But if you look at the shorter term picture or the way back, the cycle from 2013 to date, you can see that it hasn't been as strong as Manchester, for example. So therefore, by looking at the crash data for a city, the more severe the crash was for that place, the more you should watch out for the future, because history does kind of doesn't repeat itself exactly, but it certainly rhymes. Another very good example, just to finish up on this, and bear in mind, like I said, there'll be screen grabs. You can look at it all in detail. But if we look at, say, Tyneside, for example, it was it had a very relatively rough time in the crash. But if we look at the shorter term picture, it hasn't really done that great. So you could say weak, fairly weak on the way down, fairly weak on the way up. And these kind of patterns persist everywhere. So just look at each area on its own merits, look at the story of the area from the data point of view, and then layer it up over time, and then you can start to make some judgments as to whether you feel confident that that area will be good as a capital growth prospect for the future.